Hi guys, welcome to the Lazy Investor channel. So this is a very basic introductory video on options. In this video, we will be discussing what are the different types of options and what is an option expiry, what is the lot size of an option, and we will also discuss the most important part, which is the option premium. So this video will be discussing mainly option premium in detail, and I have made separate videos explaining call options and put options. Maybe after watching this video you can move over to those videos, so consider this as the basic introductory video for a beginner. So first of all, let us discuss what are the two different types of options. So there are call options and put options in the Indian markets, and they are denoted by CE and PE. So CE is for call European and PE for put European. So what are European expiry and American expiry? We don't need to get into the details of those. For now, you just understand that there are two different types of options, call and put, in the Indian market. And then comes the expiry. So expiry is basically that every last Thursday of that month, the options get expired. So there are basically two different types of contracts, which are weekly contracts and monthly contracts. So taking an example, let us say that there are options of a stock, and then there are options of index. So as I already told, that there are two kinds of options, put options and call options. Now put options can also be of index and they can also be of stocks. So what are stock options and what are index options? So basically index options are options on Nifty and options on Bank Nifty, and there is another index which has options currently, which is Fin Nifty. So these are the indexes which have options. So all three of them can have puts also and calls also. Similarly, there are stock options. Stock options can be options of, say, stocks like Reliance or Apollo Tires. So these are stock options basically. And again, stock options can also be both call options and put options. So coming to the part of expiry basically. So expiry is when an option contract expires. So it stops trading. It cannot be traded anymore. So expiry is usually the last Thursday of a month. And if the last Thursday is a holiday, is a government holiday, then it becomes last Wednesday of the month. So the expiry is preponed in cases if the Thursday is a holiday. Now there are two types of expiries again in Indian market. One is a monthly expiry, as I said, last Thursday of the month. Then there is a weekly expiry. Weekly expiry is only on, so weekly expiry is every Thursday. But there is a catch here. So monthly expiry is only for stock options, whereas weekly expiry is only for index options. But index options also have a monthly expiry. So basically you will get one expiry in a month for stocks, but you will get 4 expiries or 5 expiries depending on how many Thursdays are there for indexes. Now there is a minor change here, that when I talk about index options which have weekly expiry, so they will have either 4 or 5 expiries depending on how many Thursdays are there. So those are basically only for Nifty and Bank Nifty. For the Fin Nifty, the expiry happens on Tuesdays. So Fin Nifty has a weekly expiry, but it happens on Tuesdays. So it basically depends on how many Tuesdays are there in the month. So if there are 4 Tuesdays, there will be 4 Fin Nifty expiries. If there are 5 Tuesdays, there will be 5 Fin Nifty expiries. So to summarize, guys, basically if you have Fin Nifty, you have Tuesday expiries. If you have Bank Nifty or Nifty, you have Thursday expiries. And if you have anything else, any stock options, then you have Thursday expiries, but only last Thursday. So only once they have expiry in a month. So this is weekly and this is also weekly. So this is the summary of expiries. So every option contract will expire at some certain point of time, and in any broker you can see the expiry listed along with the contract name. So now coming back, so then there are lot sizes. So every option contract has a lot size. So it is not always of, so the quantity of a single lot will have a certain number of shares or certain number of the underlying. So that is called as a lot size. So to give you an example, the lot size currently of Nifty options is 50. So there will be 50 quantity in a single contract of the Nifty options. Similarly, the Bank Nifty option, whether it's a call option or a put option, has a quantity currently of 25. That is the lot size. And lot sizes of stocks depend on the prices of the stock. So currently, let us take an example that Reliance has a quantity of 250 when it comes to the lot size. Similarly, stocks like smaller stocks will have higher quantities. Smaller price stocks will have higher quantities. Like currently, PVR is having a quantity of 407 shares. So one option contract is equal to 407 shares. So the lot size is depending on the underlying. So if the underlying is a stock like Reliance, lot size will be 250. If the underlying is PVR, it will be different. And if it is an index option like Nifty or Bank Nifty, the lot size will differ accordingly. And these lot sizes can be changed depending on the changes in the prices. So Bank Nifty used to have a lot size of 40 when Bank Nifty was hovering around 25,000. But now since Bank Nifty has grown up a lot, so its lot size has reduced. So lot sizes can also keep changing, but they change very rarely. So now coming back to the most important part of this video. So option premium, what is option premium and how is it calculated? So to understand the option premium, first we have to understand what it is made of. So first let us understand what all is contained inside an option premium. So option premium is the price which we pay for buying an option. And option premium is actually a sum of two values. So one is the intrinsic value plus the extrinsic value. Now intrinsic value has a straightforward formula, whereas extrinsic value depends on a lot of things. So extrinsic value sometimes is also known as time value, but it's not strictly speaking only time value, but for the sake of simplicity, many people call extrinsic value as the time value of that option, and intrinsic value has a straightforward formula. Now we'll go to the formula next. So a call option has an intrinsic value formula of current stock price, or I should say current underlying price, because it can be a stock or it can be an index, minus the option strike price. So option strike price is the strike price of an option contract. Similarly, the put option has a intrinsic value formula of option strike price minus the current underlying price. So both of these are formulas for the intrinsic value. And then there is extrinsic value, which I will be getting back to in a while. So now let us take an example and then try to understand this. Okay, so I have logged into Zerodha here, and let us open any option chain. So maybe I'll open in Nifty itself. So let's say Nifty, any contract I am going to add to my watch list. And then from here, I am going to open the option chain to see all the strike prices of that option available. So here I can see all the strike prices of Nifty and their option premiums. So this is LTP, this is the last traded price. So this number over here in this column is the option premium of calls. Similarly, over here on the right hand side, this LTP denotes the last traded price of the puts. So let us take examples one by one and try to see what is the intrinsic value of these option strikes.